I would expect money to rotate back into AI. I would expect healthcare sector, especially some of the overbought stocks, to correct going in next month. And I will expect people to spend a lot of money in these 2 months. In addition to that, we may get a rate cut in December. We may get announced for next Fed chair. We most likely will see a lot of deals happening with other countries. I know the trade deal between India and US is getting finalized at any time now. Tariffs has come down a lot on consumer goods. So a lot has changed in the last. Happy Thanksgiving to all of you. Thank you so much for being part of my life. Whether you are part of our free WhatsApp group, part of my coaching program, or you happen to be my tax client, I want to let you know that I wouldn't be here without you. And every single day, I think about how I can deliver better value, how I can build better systems, how I can, help you improve your overall financial life. Now, those of you guys who are new to my channel, let me remind you guys that I'm not an investment advisor. I'm not here to tell you what to buy, what to sell. In matter of fact, my recommendation is don't buy what I buy and don't sell what I sell. Just use that as a starting point and see whether you agree with the underlying thesis or not. Today, I want to talk about some of the changes that I have recently made to the portfolio. Why did I make those? And do I see risk with some of my existing picks? I want to talk about that. Number two, I want to talk about what's going on in the economy. And number three, what do I see in 2026? So I think if you like to learn finances, I think you're going to find this very, very exciting. So let's start about with the portfolio changes. First of all, I'm not bearish on any of the picks that I have picked in last few months. Okay, I think they're all going to be fine in 2026. And that's what I have been saying for the last couple of months, that this portfolio is set for 2026 at this point. Okay, that's point number one. So you might say, well, then why are you making adjustments right now? Well, the reason why I'm making adjustments right now is because my allocation significantly increased. So for example, you guys know for speculative bets, I do not want exposure more than 3 to 5%. But over the last month or so, my exposure increased to almost 8 to 9%. So it almost doubled, which is out of my comfort level. And I was okay with that exposure until we saw a major drawdown in the growth stocks. And that got me a little bit worried because I don't have any capital sitting on the side to take advantage of any dips. So that's why I said, okay, maybe it's better off that I create some liquidity and diversify at this point. And cool thing is, a lot of those other stocks that I want to buy were also down 40 to 50%. So just by moving that capital, even though I take a little bit of loss on some of these picks, but by moving them to other sections, I'm still buying them at 40 to 50% below their price that was available to me a month ago. So I'm okay with that. So once again, not bearish at all. I'm not eliminating all of those bets. I still own those stocks, just reducing my overall exposure. And the reason for reduction is that markets have a lot of opportunities. Even today, look in the market and I go like, oh my God, if I just had money, I would buy this, I would buy that. But at the same time, valuations remain all-time high, and that creates jitters in the market, drawdowns in the market. So going forward, I'm going to be implementing some policies. From time to time, we will be booking some profits and building a separate bucket to move those profits into low beta investment opportunities. So that way, when there is a major drawdown in the market, which we will have at some point in future, we will be well prepared for that. So that's one thing I do plan on doing going forward. Now, if you guys remember at the Wealth Summit, I talked about the K-shaped economy, right? And I said, look, some companies are doing very, very well. Some companies are doing very poorly. And there's a reason for that. And the reason was consumer confidence. So consumer confidence once again dropped in November. I think it's dropped to about maybe 7 points and down to about 88.7. This is below expectation of 93. This marks one of the lowest reading since early 2020. Levels last seen when the pandemic shut down the economy. So can you imagine so many people in the United States believe that this is the beginning of COVID? The decline that we experienced recently was broad-based, with particular weakness in current business conditions, job availability perceptions. The University of Michigan Consumer Sentiment Index remains near 70 years low, reflecting ongoing stress among the lower income US households. So why are they worried? Why are they not investing? Why are some of these companies not doing good? Well, there's plenty of reason. Inflation, persistent price pressures have eroded purchasing power of people. The other day I was at Costco. I saw a lady staring at one particular product, and she goes like, I was able to buy it for half the price just a month ago, and now it's double. So do you think that person is going to invest in market? Probably not. Then we have tariffs and trade tensions, particularly affecting import dependent sectors. So we saw a big decline in transportation. We saw a decline in a lot of retails. So we saw all kind of sectors getting hurt from that. Then we have political uncertainty and government shutdown risk. I mean, that is going to get worried. Now, remember, we just, got out of shutdown. Now we're going to see another one possibly in January. Can you imagine, right before January, people are going to panic and start selling off because they will remember what happened in this shutdown. So that's another reason. Then we have a job outlook. A lot of people are out of job, especially in the lower wage sectors. People are still struggling. And we saw Home Depot earnings, right? Home Depot is telling us that, hey, people just don't have appetite to buy a lot of large purchase items. We're seeing that in home building section. We're seeing in appliances. We're seeing in vehicles. So it's a common theme. The consumers are cautious and financially stretched, at least on the lower end, even as broader market data suggests that economy is very strong. So the K-shaped economy that I talked about, it's two-track recovery. Some groups are thriving while other groups are left behind. Investors in technology and growth stocks, for example, are doing very well. Big tech companies like Apple, Microsoft, Nvidia that benefited from digital acceleration. Luxury sectors and high-income professionals, their wealth grew. Homeowners and asset holders, they gained equity and their property values all continue to rise. On the other hand, the lower arm people, small businesses, particularly those in hospitality, travel, and brick and mortar retail store, are actually struggling. Low wage and hourly service workers may be facing wage stagnation or reduced hours. Middle and lower income household hit hardest by higher living costs and limited wage growth. The contrast between S&P 500 gains and University of Michigan Consumer Sentiment Survey can be seen as Wall Street up, Main Street down. Now, at the beginning of Trump administration, that's what this administration promised, that they're going to focus more on Main Street. But so far, that is not really working out. You can look at different angles. For example, you can take a look at stock market versus small business closures. More small businesses are closing. Restaurants, mom and pop stores, they're going out of business on a regular basis. GDP growth versus real wage gains. GDP is growing, but wage gain is not there. Corporate profits are all-time high, but household savings are declining. Manufacturing activity is lower, but tech investments is growing. So there's a wide range of difference in our economy. Now, the recent market pullback, where did it happen? Particularly in AI, crypto, and tech stocks. Why did it happen? Well, a lot of different reasons. Liquidity was one reason. And I think Feds have something to do with it because they've probably felt that market is hot and they want to cool it down a little bit. But if they would push a brake, if they remove a lot of liquidity, that would have crashed the market. They didn't want to do that. So they just kind of, slowly remove that liquidity from the market, and that cooled things down. And then on top of that, we start hearing news about AI trade is dead, why there's a lot of overvaluation and some sort of fraud going on. That got people really worried. However, these corrections are mostly healthy consolidations because some of these trades been up a lot in last 6 months or so. So why shouldn't they cool down? Investor psychology plays a big role. Short-term declines can spark emotional decisions, underscoring the need for disciplined strategies. According to the Bull Bear report, the macro backdrop remains seasonally bullish heading into December. Historically speaking, December is the strongest month for equities, thanks to what we call the Santa Claus rally. That typically yields 1.5% to 2% average gains. Corporate buybacks continue to an estimated $5 to $6 billion per day. That provides a good steady demand. Institutional investors remain underweight in tech, leaving room for repositioning and potential upside momentum. Despite these positives, underlying market breadth is still weak, although it has improved in the last few days, and volatility is elevated, suggesting that a rally could remain fragile. Now, if we take a look at technology sector, there's a lot of oversold conditions in a lot of tech names. For example, take a look at Salesforce, Microsoft, Oracle, Palantir, and Nvidia. These could see buying interest as the market rebounds. Sectors that were previously overextended above long-term means have now largely corrected. Healthcare, once again, is oversold. At this point, it's about 12% above its long-term average. That means a lot of people, especially the institutions, might want to take profit. Gold and gold miners remain significantly above trend, while technology and discretionary sectors are positioned for technical bounce. The overall market setup remains bullish, with nearly all sectors except staples showing positive moving average crossovers. The first 2 weeks of December are often volatile due to mutual funds capital gain distribution and tax loss harvesting. Any short-term weakness could set up the Santa Claus rally as institutional investors engage in year-end setup. I would say it's a good idea to have some cash on the sidelines, so when you see an opportunity, you can take advantage of it. Focus on rotational trend. Watch for money shifting back towards tech and discretionary sectors. Maintain discipline amid emotional market swings. Retail spending. That is going to be one area that a lot of people will be watching. So what do we know? Well, US online sales forecast to hit $11.7 billion, up 8.3% year over year. Last year record was $10.8 billion. This is according to Adobe Analytics. National Retail Federation, NRF, overall holiday sales for November-December projected to exceed $1 trillion for the first time. Expected growth, roughly about 4%. Deloitte predicts a modest rise of about 3% as inflation, tariffs, and debt burdens cause consumers to be more cautious. Bain & Company is forecasting 11% growth during Black Friday weekend, but only 4% overall holiday growth. Shoppers turnout expected to reach 187 million. I think last year that number was about 183 million. So people are expecting to do a lot of shopping during this time. Average discount on electronics, toys, home appliances can be anywhere between 20 to 30%. So take advantage of it if you're looking for something. Consumer spending is expected to shift toward essential and discounted categories with less emphasis on luxury or discretionary goods. The US economy is displaying strong surface level indicators, record market highs, solid corporate profits, but deep underlying there are some problems. The K-shaped divergence between asset owners and wage earners is widening day by day. Markets are poised for seasonal strength, but consumer strain remains a long-term risk to sustained growth. And that is why I'm planning on implementing the changes that I discussed. We'll talk more about that coming in our next discussion call. But here are some ideas that are cooking in my head right now. Number one idea is I can maybe reduce the exposure to growth stocks that can go up 50 to 100% over the next 12 months and move towards a little bit more safety. And that can reduce my overall performance. So that's one idea. The other idea is that maybe from time to time, I start doing more profit booking, and to certain percentage of the portfolio, I can set up a stop loss. So for example, at the beginning of this month, we discussed that most likely market's going to be choppy, and I expect markets to fully recover in 3 to 4 weeks. Okay. Now imagine instead of just doing that, if we would have booked a profit for 20 to 25% of the portfolio and was able to use that money to buy big discounts at the bottom of this drawdown, that would have posed our portfolios even better. But I stick with my existing plan, which has worked very well for me for many, many years, which is just continue to buy the dips. Simple process. When market drops, I buy 5%. If it drops 10%, then I buy a little bit more. If it drops 20%, I buy a lot more. That is exactly what I did. But that kind of put me in the corner because that removed all the liquidity from my portfolio. And that's why I had to make some adjustment. But going forward, I think better approach will be is that I generate liquidity by booking profits on regular interval. So you're going to see that. Now, there's other reason for me doing that going forward as well. And I'll talk more about that in great length at our next discussion call. But for the time being, I would expect money to rotate back into AI. I would expect healthcare sector, especially some of the overbought stocks, to correct going in next month. And I will expect people to spend a lot of money in these 2 months. In addition to that, we may get a rate cut in December. We may get an announcement for next Fed chair. We most likely we'll see a lot of deals happening with other countries. I know the trade deal between India and US is getting finalized at any time now. Tariffs has come down a lot on a lot of consumer goods. So a lot has changed in the last couple of months. So I'm still very, very bullish on the market, but I think going forward, we have to be cautious and adjust our strategy. To me, life is so simple. You need to build systems. If you build the systems and put those systems in place, then systems work. And when you see the market conditions changing, you simply adjust the systems. And that is exactly what I plan on doing. And I think that is going to result even a better outcome in 2026 than what I'm getting in 2025. I hope you find this information helpful. And once again, thank you so much for being part of my life. Thank you so much for being part of our community. If you have any questions, anything I can do to help, please don't hesitate to reach out to me, and I'll see you at the next discussion call.